All right, we should be okay, Ken. Greetings. Greetings, everybody. Ken, did you want to do the introduction or are you okay?
Okay, I will. Good evening, everybody. This is Ken Cavula from the Mid-Michigan chapter of Better Investing. I'm joined this evening by three of my good buddies, Cy Lynch from Atlanta, Matt Spielman from Houston, and Mark Robertson, who's a director on the Mid-Michigan chapter, and he lives down in Rochester Hills, about 45 minutes south of where I am in Mid-Michigan. We have been doing this program for over 15 years. In fact, we're coming close to our 16th anniversary in the next couple of months. And as long as you keep coming, we'll keep trying to put this program on. We are at 7 o'clock Eastern time now, and we'll stay at that time for the next couple of months at least, trying out this new time and seeing how it works with some of the other programming that's going on in Better Investing. Tonight, we're going to present 4 stocks to you, and we're also going to do a little bit of advertising for some programs that are coming up and that we're kind of excited about that we're going to run in September and
That's
maybe
fine.
do as on a quarterly basis going forward. So, Mark, let's get this disclaimer out of the way. Let's see if I can beat your 15 seconds, okay?
Okay.
You got to switch the slide, though, Mark, for me.
I think I did. Are we sluggish tonight?
I am there. It just switched. Okay.
Taking a little
The
bit longer.
important thing on
So.
this slide is the important thing on this slide, folks, is that no investment recommendation is intended. Everything that we talk about tonight is for educational purposes. You've seen this slide hundreds of times if you're a loyal Better Investing member or a loyal attendee of the roundtable. Those are our emails at the bottom. If you want copies of the slides, send either one of us an email. If you have questions, if you'd like a few answers, do the same thing. And if you have ideas for things that you'd like us to do at the roundtable or at any of our bull sessions, send those to us as well. If you'd like to be added to our guest list, then go to the Mid-Michigan chapter page on the Better Investing homepage, open us up, scroll down to the bottom, and you'll see a box where you can subscribe to our guest list, where we will inform you then about these programs that are coming up on a regular basis. Let's go to the next slide, okay, Mark?
Okay. Keep in mind it's running a little bit slower for whatever reason, Ken. I am actually in the sticks. So I'm
running very slow.
It's running pretty slow. That's the switch, and this is size cue. We're actually honoring the Georgia chapter here tonight, and I thought Cy might want to just extend an invitation to an event coming up in about a month.
I would be glad to. As you can see, the Peach State is hosting an education fair that will be in person, and that is in 3 weeks, I believe.
Yeah, is it August 23rd?
Trying to get the 23rd. So just over 3 weeks away on the 23rd, which also happens to be the day before I go on vacation. But who's counting that? And we will have some distinguished guests from Michigan, to include Mr. Robertson, as well as Susie Artsberger. And I'm not exactly sure where Doug is from. I guess it varies from day to day.
Just go with America. Somewhere in America.
Yes, somewhere in America, Doug will be coming from. But we hope that you can join us there. I do not believe that there are plans to do a hybrid, so you will have to come join us in person. But it will be a great day of investing with some fun people. So I look forward to seeing Mark and Susie and Doug, and hopefully many of you.
Thanks, Cy. All right, so while I'm trying to watch the audience view, Ken, in the control panel and not get ahead of the slides. So here's a look at the investing roundtable performance. We continue to be kind of amazed by what we're witnessing here because we're not doing that badly. Our rate of return since inception is still 15.9 on an absolute basis. The Wilshire 5000, however, is smoking hot. And, other than that brief uh, turbulence we had a few months ago, it is now up to 14.2% over the total of 15 years for the roundtable. So we're still beating it by 1.7%, but you can see that our flirtation with plus 5% is something that we now must aspire to again. We've kind of drifted away a little bit. Now, for context, please understand that places the roundtable in the top 10% of all institutional funds. So it's not like we're sudden failures. It's hard to keep up with the Wilshire 5000 when it's going this crazy. And we'll just keep doing what we know works, and hopefully we will drift back towards that plus 5% market outperformance line. And but the real highlight here is I've been telling you guys for a few months that there's this huge pile of stocks that are just barely below that $1,000 threshold. When we originally invested in them, well, a lot of those are percolating and percolating quite well. Obviously not enough to make a big difference in that relative return number, but our outperformance accuracy is up to 54%. I think that's kind of cool. So Ken, did you have thoughts on the mysteries that we're walking through right now?
Well, this is an ugly graph right now, Mark. So I'd like to see us be able to turn this around in the next 3 or 4 months. And I know that we're going to be doing some work at some of our bull sessions in taking a hard look at the roundtable portfolio and maybe making it a little bit slimmer and a little bit more efficient. But I still can live with 2% relative return. And like you said, it does place us still in pretty rarefied territory as far as institutional mutual funds are concerned, and especially this being a mutual fund run by 15 or 20 amateurs. That's a pretty decent thing to be able to demonstrate, I think.
Mm-hmm.
Yeah. Have either of you done any looking? I was trying to call up a chart just to try a 10-second research project, and I didn't get it done fast enough. I may do it after I finish saying this. But with so much concentration of return being in the very high super mega cap tech stocks, particularly in the last year or so, is there an even wider disconnect between cap weighted indices like Wilshire 5000, like the S&P 500, and equal weight indices? Seems like last time I looked, there was a fair bit of disconnect, which is not unusual in a bull market because of the effect. But is it even more exaggerated now, and might that account for some of the relative underperformance?
It's definitely now visible where it wasn't. I mean, they're basically on top of each other for a while. But the one thing that we do notice in very bold relief is you take a look at the NASDAQ 100 and you compare that to the S&P 500 and the value line arithmetic average, and we don't remember the last time we've seen the value line arithmetic average, which is going to be that all of the above equal weighted index that Cy's mentioning. It's been a long time since we've seen a difference that big, especially when compared to QQQ. Very long time.
Yep. I don't have data from the roundtable portfolio, but the Mid-Michigan Model Club, every month when it meets, it shows our 1, 3, 5 year and our entire history as compared to the equal weighted S&P and the normal or
cap weighted.
Cap weighted, get the right words out there, Ken. The cap weighted S&P, and Mark is right, for years there was very little difference between how much we beat one or how much we beat the other by. But recently, the last maybe 14 or 16 months now, there's been a difference of 3, 4, even 5 percentage points between the behavior of those two indices. And then, of course, how much we beat the index by varies a lot because the indexes are deviating from each other. So we're seeing that happen in our model clubs portfolio, and our model club is about 20 years old. We're still beating the equal weighted portfolio quite handily, but we're having a much more difficult time maintaining our lead over the cap weighted S&P 500.
Yeah, and the fact that
And of course, also remember, since you mentioned the long term, remember also that that because of the way compounding and everything works, recent underperformance will also get exaggerated in the overall. It obviously won't impact previous years, but your overall, 100% of gain in last year's portfolio is a lot more than 100% gain in your portfolio 10 years ago.
Absolutely.
yeah,
Yeah.
and it's also a reminder that it's simply not the worst time ever to get out there and find the smaller, faster growing companies and the medium-sized companies. Because if that outperformance accuracy is nudging anything, it's that some of those off the charts companies are behaving pretty well. All right. Anything else here?
I think we've beat this one up pretty well, Mark. Let's move on. Okay.
Let's press on to our top 20 then. Again, we don't want to spend a lot of time on this part of the program, but it is helpful to check in and just make sure that we do this.
We do show you this every month. I like to keep track. I look at this once or twice a month, and I look at what Microsoft is doing, and it's about 130,000 right now, which is quite a bit better than it had been back in, March, April period of time. So Microsoft's really contributed a lot to keeping us above the average. And it's just that this portfolio is just like any other portfolio that I'm involved with. It does not contain all 7 of the Magnificent 7. And because they have contributed so much to the advance of the S&P 500 or the market as a whole, we're having a hard time keeping our butt out of their teeth, out of their mouth. So they're chasing us real hard. So
yeah, there's a number of things here. Ardelyx has not helped lately. Hopefully that will change soon, or I'll cry myself to sleep at night. But yeah, there's a lot of good things bubbling around here also, and we'll be taking a closer look at maybe doing some house cleaning, and Ken and I will wrestle a little bit in future bull sessions, and we'll share that with all of you. All right. Yeah, I do want
to report about a wonderful thing that happened to a stock that we presented a while ago called MedPace Holdings, MEDP. In one night, about 3 or 4 days ago, it went up 54% after presenting a bang-up quarter. We only own 2 positions in it. The audience was smart enough to double down on the presentation of MedPace that evening. So we do have some stocks that are really beginning to perform, but we need to get another 15 or 20 of them to begin to move up the list here.
And I would also like to respond to Ann Manning and point out that Deckers has actually recovered a little bit. She was she expressed her own consternation that after I picked it, the stock price allegedly went down several percent. Well, maybe more than allegedly, it did go down several percent, and she was happy to see
Mark,
that
we have a hand up. Kimberly's hand is up. So Kimberly, you'll have to unmute yourself, but if you unmute yourself, you can talk to us. That must have been an inadvertent hand, Mark, so let's continue, okay?
Keep in mind that Ann did recently present Deckers. We've got great hope for it. All right, so let's go ahead and move on. and get into the roundtable program if you're ready, Ken.
I am ready, Mark. And I'm going to present a company that has been in the roundtable just one time previously, a little bit over a year ago. One of our directors, one of our Mid-Michigan directors from the Traverse City area presented Ensign Group, and I'm going to present it again. The ticker is ENSG. And if you could go to the first slide of my presentation, Mark, this is directly from their very recent investor presentation. In fact, it's a July investor presentation, so the numbers are quite current. And you can see that this is a healthcare services operator with a fairly unique business model. And we'll talk about that as we get through the presentation right here. You can see that they are quite large with 348 different facilities. It's been around since the last century. It was founded in 1999. They have a quite decent occupancy rate, especially when you compare it to occupancy rates of smaller healthcare services operators. That 82% is really quite a good number when you do some comparison with other places. And they have been quite profitable over their history. Let's go to the next slide. They operate, this circle graph on the left over here are the different types of healthcare that can be given in various stages of life. And the types that have that Ensign scroll underneath them are what Ensign actually specializes in. So you can see that they do an awful lot in the skilled nursing area and in senior living, some in outpatient rehab, some in acute care, but they do not make an attempt to answer every single issue that's there. They stay away from example for home health care and from hospice, but they are pretty comprehensive when it comes to dealing with the elderly, the people that might have memory issues, people that might have physical issues. And like I said, they have a lot of experience and a very unique business model. Let's go to the next slide.
Should be coming.
They operate in the dark shaded states. They stay out of the Midwest for the most part. They stay out of the Northeast and the Deep South. They're just beginning to penetrate into the Deep South right now. But you can see they have a large presence in Texas and California, two of our bigger states, and then of course a pretty good presence in the entire western part of the U.S. They tend to have their facilities where the weather is a little bit better than you might find in Michigan or Ohio or Indiana, Wisconsin, places like that. But they are pretty widely spread over the country with a lot of room to continue to grow. Next slide.
And Matt is with us too, so you know, Ken.
Okay. Here's that business model I was talking about. They call it the cluster model. And instead of operating each of their facilities as an individual facility and then trying to maintain a hierarchy with one person in charge of the whole thing, they've divided the country into different clusters. And those clusters might contain 3 or 4 or 5 or as many as 7 or 8 of their different facilities. And they allow the clusters to basically govern themselves and then be responsible in reporting to the headquarters and also take responsibility for a lot of the innovation that might be going on, a lot of things that might be geographically unique to where they are, but they tend to have this organization that takes responsibility and kind of farms it out to smaller groups and gives them a lot more say in what the rules and regulations are going to be to meet the needs of their particular clientele. It's not what you will see in most of the other facilities that deal with healthcare nationwide. Next slide. They have chosen to put a huge organizational focus on quality. And quality is something that at Manifest Investing we talk about all the time. As better investors, we focus on high quality companies. And Ensign has decided that one of the ways to make more money is to have higher quality units within their business model. So they've focused on units that were rated 1 star. That would be the lowest rating you could get. And they've made a concerted effort in the last 15 years to raise that 1 star higher. They don't set a final goal. They'd like it to get as high as it can, but they're keeping track of their 1 stars. And notice that as their number of 1 star facilities falls, and the general trend has been a falling trend in 1 star facilities since 2009, that is matched with a equally impressive gain in adjusted EBITDA trend. EBITDA, earnings before interest, taxes, depreciation, and I don't have the R in my head, folks, I'm sorry. But they've been extremely profitable, and they attribute a lot of that profit growth to the fact that they're moving from 1 stars into 4 to 5 stars. And you can see at the bottom on that top graph where they're pointing the arrow that the number of 4 to 5 star units has consistently been moving up, with a couple of exceptions, year over year over year. And the 1 to 3 star facilities have been moving up as well, with the number of 1 stars falling considerably. Next slide. They make a very disciplined approach to acquisition, but they are an extremely acquisitive company. And the reason that they're acquisitive is that this is an extremely fragmented industry. Ensign has a little bit more than 2% of the business in this kind of healthcare, in the long-term care, in the acute care, about 3%, a little bit less than 3% of the business. And they've decided that to be truly a national player, one of the best ways to do that is not just to grow organically, but it's also to add units on a regular basis. They've had a lot of luck in taking units that they've purchased and in just 5 quarters moving their occupancy rates considerably higher, moving their margins considerably higher, and moving their revenues considerably higher. You can see the measures. BPS stands for basis points. So that's a 3.5% gain in revenue, a 3.25% gain in margin, and a 4.5% gain in occupancy in a newly acquired unit. And that tends to happen in just 5 quarters. Beyond the 5th quarter, out to the 45th quarter, you can also see what happens to revenue and occupancy. Next slide. Part of their business model, a large part, not half, but coming close to half, is a REIT, an R-E-I-T, but it's part of the total company. It's called Ensign Triple Net, and basically they own a lot of the real estate that they have their facilities located on, and they also own facilities that are third-party operators. In other words, they own the land that other companies lease from them. This REIT is extremely well managed, and it spins off a significant amount of profit. Next slide, please. The Ensign Group, therefore, is built into independent subsidiaries. That's those clusters I was talking about. And they basically focus on skilled services, senior living, and new ventures. And then they have the REIT, and it's called the standard bearer, and it owns real estate, and it leases that real estate to the independent subsidiaries from Ensign Group, but also to third parties. Next slide. You can see where the real estate is located. It mimics, for the most part, where the facilities that Ensign Group operates are located. But again, there's plenty of room for geographic expansion for this part of their business as well. Next slide. Up straight and parallel, that's the name of the game as far as I'm concerned, and that's what Ensign is demonstrating. This is a little bit choppier on earnings than I normally take a look at, but this business model has its ups and its downs because it depends in great measure not only to funds that are being paid by the people that are living in these facilities, but they get a lot of their money through Medicaid and Medicare as well. And that's not as consistent a stream of income as the funds from the people that pay the money to live there would offer to them. It is at a pretty high level, the growth rate, however, the slopes of those lines, and if you'll go to the next slide, Mark, we'll see the slopes of those lines. You'll notice that the sales are growing at about 12.5%, and that's over a pretty straight line, which means that that's about a 10-year average that's remained consistent. The 10-year average for earnings is even healthier than that, almost twice as much as the sales growth, but it is a little choppier. I've decided to estimate growth going forward. I'm going to keep that 12% sales growth, but I'm estimating earnings growth at about 15%. That comes pretty close to a preferred procedure, and it comes pretty close to the sources as I look through the various sources that are making analysis calls on this particular company. The debt number on first glance appears to be a little bit daunting. It's in the 50%, but then I remind myself that leases, and this company deals with many leases for a lot of its property, leases have to be expensed to the SEC as debt to capital. If you look at interest coverage, however, for this company, you'll find that the interest coverage for the last 5 years or more has been over 30, especially since the pandemic. And that indicates that even though this debt appears to be higher than we would appreciate, the leases are kind of interfering with the veracity of that number as far as what we're looking for, and the debt appears to be well in hand for this company, and they are moving that debt in a downward direction since the leases had to be added to the long-term debt in 2019. You can see it's gone from 67% down to 52%. Let's move on. I did strike the pandemic low of 7.9 from the low PE list. And then basically I'm going to be using the averages that come on this section 3 of the SSG. I'm using the average going forward. I'm going to call 29 for a high PE, and I'm going to call 2020 for a low PE. I did go a little bit lower than the 5-year average, which was 20.7. Mark, you're underlying the current, and the 5-year average is 28.2. So the 28 is I've gone to 29 for that. Not very much different, but that's where I am. That gives me an average PE of 24.5. And next slide. And that gives me a par value of 12.8%, all the way up to a total return value of about 16.5%. So I think somewhere in that range is where I have a good chance of making money. And my par value of 12.8 is certainly commensurate with the manifest par value of 12.7. Okay. I will tell you that manifest investing, the database that Mark depends on, does use a much higher sales growth and earnings growth rates than I was using in my SSG. But to balance that out, it uses a much lower average PE value, and they come up with the same value that I do. So I think either route gets you to the same place, about 13% to maybe as much as 16 or 17%. One more slide and then I'm done, Mark. Notice the fragmentation of the industry. Ensign Group is the largest player among national healthcare services companies that do the same kind of thing. You can see some of the other companies are called out there on the graphic, but most of these other facilities are much, much smaller than 1% of the whole. So there's plenty of room for acquisition and for growth. And then the key driver of that acquisition and the organic growth will be the fact that by 2060, the population over 65 in this country will nearly double. By 2060, the population of over 65s in the country will double. And that means it'll be a growth rate from 2022 to about 2030 of over 20%. That's the baby boom generation aging, and then they're living much longer than any generation in our history has ever been able to accomplish. So they're living longer. They're one of the largest generations that's ever existed, and they're going to drive this particular business model. I think Ensign Group is a compelling stock for the future. I don't think it's going to grow like NVIDIA, but I do think that this business is going to be around for a long time.
Are you good?
I'm good, Mark.
All right. Well, I guess I would summarize that story with that means you're going to be around spending my inheritance a lot longer than I would like, depleting my inheritance.
I have long-term care insurance, Mark, so I'm not spending very much on that. Okay.
All right. So what I thought I would do is just take a quick look at the overall environment for, where are there some good ideas. So what I did is I started with the companies ranked in the top 2% at Manifest that are ranked by the combination of their return forecast, their PAR, and their quality rating. And then I required basically double-digit growth rates. So that's what you're seeing here. This is the set of companies that would qualify for that. I think it definitely passes the Kavula checkpoint list where there's a number of his favorites on here. So it's a valid screen by Ken's own admission. We've also been doing a lot of work comparing cash flow growth forecasts to sales growth forecasts. I do like that these seem to reconcile pretty well. It's very hard for the sales growth forecast to be dramatically different than the cash flow growth forecast. And I think you see that most of these are aligning pretty well from top to bottom. So I think that's a pretty cool thing too. Then when we look at the bottom line results, the projected annual return, and compare that, kind of like Ken just did for Ensign Group, to the projected return on value. And those numbers are also basically validating each other or reconciling versus each other with very few exceptions. So you've got a pretty interesting set of companies that seem to be pretty consistent. These would be pretty much good studies from top to bottom. I like Ken's pick, but I think some of these are also very compelling. I'm going to basically cross the one at the top off because I think anytime you fight the government, they can change their mind on stuff, and I've been burned so many times. So could be a great investment opportunity in First Solar, but they're going to have to take that trip without me. Novo is going through some interesting times, and that's a very compelling study. As Ken just told us, people are going to live longer and they're going to need some of the products from Novo. And that takes me down to Brown and Brown. This is basically a community favorite that has been in our collective community conversation about good companies to own for a very long time. And that's the one I'm going to go with here tonight. It exhibits decent growth characteristics, and it's perhaps a little bit on sale. You see that the relative strength index is down at 35, so it's among the lower ones, possibly temporarily oversold. I think some of that pressure might be coming from the United Healthcare environment, economic environment for the insurance industry. You can see that United Healthcare is also on here, along with a couple other insurance-related businesses, and they just have been crushed. I picked United Healthcare for the roundtable a couple of months ago, and continue to have hope for United Healthcare. But I also think that Brown and Brown is so distributed and diversified that any impact that is being perceived just might be being overdone a little bit. So the value line average forecasts are there for you to see. You can see that the Morningstar ones are pretty good from top to bottom. There's a couple of exceptions. And then, as usual, when we look at a cross section like this, those rhinos, those institutional Wall Street analysts, are basically pretty frothy when it comes to these companies. They think all of these companies are pretty much on sale. So I find that kind of fascinating also. So I'm going to go ahead and go with Brown and Brown for tonight. I did want to point out, and I'll wait for the slide to catch up with me here, we are going to be initiating a series in September, and this one kind of fits the mold. David L. Babson was one of the fathers of growth investing following the Great Depression and that terrible economic period we went through in the late 1930s, early 1940s. And he was a very much a formative, influential force in the early days of Better Investing, and contributed a column to Better Investing magazine for a number of years. And we're basically going to dive into that book, Investing for a Successful Future. And we're going to basically have campfire chats at the beginning of our roundtables. We're going to start an hour earlier and just give ourselves time to have some discussions about the concepts of growth and the evolution of growth investing by the names that you see there on the slide. So we'll have some fun. This is an example of a company that probably fits that mold. Again, most of you know Brown and Brown. Waiting for the next slide to catch up. It is an insurance broker. It's basically a diversified insurance agency that handles all modes of insurance and with customers all over the place. Maybe I'll come back and disclose that next time around, but if you want to dig in deeper, there's the investor relations content URL at the bottom of the screen. And again, I think it fits with Babson. Growth has no finish line. So again, a fairly well-known company within our community, and one that has spectacularly steady performance over the years. Okay, we're going to start with the second half of the stuff that we often look at Manifest. First of all, it is a cash flow aristocrat. It has 10 years of increasing cash flow growth year over year. Kind of a spectacular picture. There's only 16 or 20 companies that fit that description out there. And the cash flow growth, again, confirms the general growth perspective or characteristic for the company at double digits, right around 10%. It's attractive in terms of the fact that it is down close to its 52-week low, We know that Hugh McManus likes that, so it's very close to its 52-week low, and that has some built-in potential. So some really good stuff. I do notice this, and this raised a interesting question. What in the world happened to make the operating margin take such a jump? I love that the net margin has been so steady. I love that the PE ratio has been fairly steady. I note that value line perhaps is even being a little bit conservative out here. And these are just some of the things we noticed. But that profitability jump, we simply have to ask a question. So I went to Grok and just said, what's something that happened that might have caused that? And as you can see on your screen, I just asked that question. And what I discovered, it's something you might want to dive into a little bit deeper, but it makes sense to me. They basically divested what turned out to be a fairly low margin component of their business. And the stuff that they've been adding in place of that are higher margin components. And that's basically how their complete product / service portfolio has been managed to generate higher operating margin. And so at least I have some conceptual understanding of what may have happened. They sold something that was performing less profitably and replaced it with stuff that is more profitable. So here we reach the bottom line. I basically am suggesting a sales growth forecast of about 14 and earnings growth forecast of about 16. Both of those numbers are, they basically give us a warm, fuzzy feeling. And the quality of this company has been steadily improving. It is a top tier quality company in terms of all of the business characteristics that they have. We noticed that the projected annual return is trading near a multi-year high. So this is an opportunity. Again, much like the cash flow growth thing that we talked about on the previous page, the sales is quite good. Value line might be even a little pessimistic out here compared to that long-term trend. And so you are looking at up straight and parallel. You are looking at a company that has languished a little bit on the price side. And I think I can live with that. The fact that the projected annual return is 14 and the projected return on value is 13, that also is consistent and validated. And I've just got a good feeling about this company. This is the type of company that I think we want in the roundtable. And it's one of those companies that I've often wondered, like your O'Reillys and a few others, where are they? And I think it's time to add Brown and Brown to the portfolio. And then last but not least, I happened to be vacationing with my 5-year-old grandson, and he saw this picture as I was going through the investor relation materials. He's a cheetah fan. And he said, Grandpa, you put the picture of the cheetah in there and they'll vote for you. So don't let me down, people. Or more importantly, don't let Logie down, because Logie is
shameless. Shameless.
So that he is their mascot, and it's a good thing. Good stuff. So I'm going to go ahead and go with Brown and Brown tonight. BRO. Have fun with it. Go ahead, Cy. United Therapeutics.
All right. Thank you, Mark. And, this is just going to be a straightforward investment merits presentation, not relying on cheetahs or children or even aging baby boomers. We're just going to talk about investments. And in true silage tradition, maybe I'm falling in love with United Therapeutics, since I'm bringing it, I think, 3 out of the last 4 months. And we'll talk about that in just a minute. I will also note that the company is supposed to report earnings before the market opens tomorrow, and I have it on good authority that they will be announcing a merger with some IT consulting firm. So we'll be getting into the CTSH and all of those
and you
arenas as well.
of stretching.
But please hear the big /S on that latter part. But United Therapeutics, we have had presented to the roundtable. Actually, I think 4 out of the last 5 months, counting mine, and then Ken and did it the month before, I believe. But you can see from a sales perspective coming out of 2020, solid, and earnings kind of lagged about a year behind. So it's not a perfect up straight and parallel, but they had some drugs come online, Tavaso being the largest one, which is a cardiovascular anti-clotting agent that has grown at about 25% since 2020, is driving much of that growth, as well as other things that we'll be looking at. Next slide. While we are waiting on the next slide, I think I remember. Yes, here we go. I was looking at a number of different screens, some of the sweet spot screen on Manifest. I was looking at some better investing online tools screens. I was also running some screens on Stock Investor Pro screening, just kind of looking for perhaps a new company. And I kept coming up with attractive potential candidates, but then when I actually did a study, I did not like them for various reasons. Many were overpriced, I felt at the time, based on my judgments. Mueller Industries that you saw earlier on Mark's screen, and it does happen to be in the portfolio as well, kept popping up on some of them. So I just said, let's do a screen based on Mueller about its par of 17. And notice it had very high quality, but I said I'll relax my quality down to just a mere excellent at 80. And here's what came up. 4 stocks came up. Nice, again, had come up in some of the other screens, but United Therapeutics, I thought, came up even a little better. And I, of course, then took a look at the portfolio, and you could see where United Therapeutics and Mueller fall in the next slide that we almost got to. There we go.
Yeah, I can't.
You see that they're right
Lumpy
in
electricity.
there. Well, you know, flexibility is an important trait to have in doing presentations online or in person. So let's take a look at the next slide, where we will get just the quick industry look. And you see that United Therapeutics is the best of the best in the biotech quality industry. And I believe they are the only company with excellent quality that is 5 percentage points above my par or greater. You could see that this chart gives you all of the good quality or better in the industry, and kind of gives you a bit of lay of the land where United Therapeutics falls. So I said, okay, it may be a repeat, but it's an excellent repeat. And I'll just kind of try and go through the next set of slides pretty quickly, because most of you have seen at least some version of this discussion and is fairly familiar with the company, and of course can dig in even deeper if you wish after the presentation tonight. Next slide. United Therapeutics is a rare disease biotech company, and what they've really caught the vision of and is looking to revolutionize and drive their long-term growth is expanding the availability of transplantable organs, because that's kind of the next phase. The diseases that they treat often in the end stages need organ transplants, those who are suffering from the diseases, and they're seeking to use genetically modified non-human animal organs as potential substitutes for human organ transplants. Next slide. Here's just a description. It started out as pulmonary arterial hypertension, PAH, and has expanded beyond that. You can see they have 6 therapies treating that and have other cardiac and pulmonary related lung disease treatments. Next slide. When the slide comes up, it will just be kind of continuing the description, and it mentions the organs that I've already mentioned. And also, United Therapeutics is kind of a hybrid between the usual for-profit corporation and a not-for-profit or charitable organization. They still have profitability as a goal, but they also must evaluate their business on public benefit capacity or characteristic or criteria. There we go. That's the C word I was thinking of. Criteria in addition to profitability. And it's the first publicly traded biotech to take that format. I think there's in the upper teens of publicly traded companies that are public benefit corporations. So it's relatively rare. And there's about 250 or so companies of that form, most of whom are privately held, that take that form. And that's a form under state law. That's not a federal or an SEC category. Next slide. Here's just their current portfolio of treatments. Tyvaso that I mentioned earlier is both their foundation and they're continuing to innovate there. And then looking at the Revolution, which is their big explosive growth in the future, includes organ alternatives. This is just the wording and then a chart that depicts the company's phasing of their foundation, innovation, and revolution is in the next slide. And here you go. That's just showing how they feel that it can impact revenues in the future to increase revenues by 4-fold or more heading out in coming years. Next slide. This is the growth since 2020. And again, you can see the kind of aqua at the bottom being Tyvaso, being a major driver of the growth, with a little bit smaller contributions by the Orenitram and Remodulin. Next slide. And this just gives, again, some of the most recent characteristics or accomplishments by each of the major drugs that you saw on that previous chart. Next slide. And then getting to the judgments, I took a, what at least compared to Manifest Database, a reasonably conservative sales growth rate. It's in line with the Morningstar analyst consensus. It's the lower end of a range of about 16 analysts that follow the company. And it's roughly in line with Value Line as well, of 9%. And then a bit of expansion in the profit margin, although that 50 that I'm using is below the current 52 to 53%, very high profit margin, and it is expanding. So if it expands even further, that will be a nice surprise. And all that leads to a almost $37 per share EPS. Next slide. And then at the current price, the price has contracted a little bit in the last couple of months, and that $37 roughly in EPS with a PE of 17 could yield about 16% total return using my high PE of 17, and then using my average PE of 13.5, it's a 10.8%, still above the market potential, but not as much obviously as the higher PE, which is well within our goal of exceeding the market by 5%. But there's certainly significant upside if the growth is even better and the market response to the growth is stronger, and that's reflected in the manifest par of 21%. So I'm adding another $1,000 in United Therapeutics. We're not going to make the mistake of buying something once and watching it sail. But again, because of some healthcare questions and everything going on, I think there's some headwinds for the company right now, but patient investors should be rewarded. So I'm going to be patient and seek reward. And the final chart again, just questioning, is this a multi-year opportunity? Notice over the last 5 years, the return has never been higher. And while there's been, significant higher prices in the last year, even the mildly depressed price only takes us back about 15 months. So I think that, again, the chronicle from Manifest is showing that this is a good opportunity to invest in United Therapeutics, perhaps.
Excellent, Si. Thanks. That takes us to healthy food consumption. And Matt Spielman. Matt, I hope you're still with us.
We're here.
Welcome back.
Yeah, I think.
You're
Thank
just
you. I
getting
think
back
we've done
from
a good job on segues today. I'll point out a couple here. But my company is Vital Farms, who makes, and we'll get more into it, but their primary product are eggs and butter, things you might have heard of. But doing it in a different sort of way. It is a native Texas company, founded in 2007, headquartered in Austin, Texas, and went public in 2020. So they happen to be, and it's nice that I'm slotted behind Si. They happen to be another public benefit corporation, a publicly listed public benefit corporation. Their particular goals, you can see they're looking to be sustainable, but are looking at animal welfare and also support of family farms. So they have a certification for that. They have a whole lot of information, probably a majority of the information on their site is talking more about their goals and sort of the big company things than exploring their products. Next slide. So one of the things that attracted them to me, besides doing good, is they have a pretty unique strategy for this business, particularly compared to their U.S. competitors. So again, they're working with family farms, so small units of production, and they have a particular area of the country in this rough map that they're looking for a number of things. They are the largest pasture-bred egg producer in the country. They look for 108 square feet per hen. They're feeding them natural food that they would find, and they're looking to be sustainable for the land, and again, from a business standpoint, sustainable for small businesses. They do not own the farms generally. They are contracted supply agreements. So this map, no, we can go ahead. This map gives a little bit more detail there. I've put Austin on. They didn't do that, but I put the star in for Austin, their headquarters. You can see how their current farm layout is laid over a number of states. you can kind of get the idea of what they call Egg Central Station, their single processing center today in Springfield, Missouri. That's where that big cluster is. They're actually growing supplying farms quite quickly. This slide, all these company slides date from their Q1 earnings in May. And so since that time, even they've signed another 50 farms, another 10% of farms in that one quarter. It does take approximately 9 months for a farm to go from signing to producing significant eggs for the company. So this is always an avenue of growth they're working on to keep that going. They also are they're building right now a second egg processing station in Seymour, Indiana, and southeastern Indiana, between Indianapolis and Louisville. So you can imagine in that map, if you think in your head compared to the map in the slide before, they are seeing a migration to the east, not just in production, but certainly in distribution as well. And being located in Indiana as well will open up that farm area for them to work with. So again, they have a large facility that they work through. Oh, we dropped dead.
Sorry about that.
And otherwise have a fairly lean headquarters staff, if you will, the back office things, including a lot of remote workforce. And they do sell both to retailers and into, they say food service, I'd say restaurants. Okay, go ahead, Mark. So just taking a first glance at the SSG, the sales line is you can hardly get better. Essentially, they're growing sales as fast as they can grow production. So they are at capacity all the time, and they're growing quite well. As I said, they IPO'd in 2020. You can see by the price bars, while the IPO day one was successful, they had some issues going into the pandemic. And are coming out of it. I wish I would have found them in 2023, which is essentially their launch pad year, even though they've been profitable, but they've had lower profits and come out into the recent year. And again, keep in mind, years prior to 2020 are as a private company, things can happen there, although I actually like the profit in 18 and 19. In 2021 and 22, they made some significant capital investments. And so as a small company, those can show up quite readily in your earnings. If we'll see on the next page. Well, here, let me talk about here. So it is growing 35% in this raw form. Notice also there are no analyst consensus estimates to guide you. This is a brand spanking new constituent of the Value Line Standard Edition. So we will get some help on there, but not a lot of help from the street yet. Pretty undiscovered. Next slide. So the company itself, in addition to giving guidance for 2025, which you'll see on the SSG later on, also has a long-term goal for 2027. To give you an idea of the business model, I will also put those lines in, and I'm using those in lieu of analyst estimates since they don't exist. Next slide. Here is that new value, and I mean new by last week, new Value Line slide. Again, in this wasn't the extended edition, it's just graduating to the standard edition. You can see I've circled the earnings per share and revenues, which I'll put into 2029 in my SSG. Now, Value Line, and this is a couple dollars higher than, I think it was 37, just about 37 closed today, but a couple dollars higher than when I evaluated it for the price. We can see the projections don't look too interesting. And so I'll talk about in particular how their projections look versus manifest later on. Next page. This is the manifest stock page, and I did start with a manifest screen. I didn't throw it all in there because I wanted to introduce the company more than talk about the process. We can see an 18.1% par, a quality of 83, even though its raw score is getting a 10-point penalty for being a young company. So great, and will even get greater just as it keeps growing. Give me one click, Mark, and bring up some Value Line comparisons. So again, big differences between manifest and Value Line in sales growth. Value Line is looking at a 15% growth, which would be half of its historical growth, and companies do slow down as they grow, but there is quite a bit of growth, both implied by the company and in looking at the overall market they serve available. And you can see how that goes. The PE ratios aren't too far off for an average PE, but that revenue growth underlying it really shows up in the earnings per share. A wide range of earnings per share to shoot for 5 years out. Next slide. So one thing I gotta say, and I've probably already lost George Mackey at this point. Back in February, they did get a note, and they filed with the SEC. They had a weakness in their reporting, in particular revenue reporting, and that's always something to pay attention to. It has been addressed by the company. It hasn't been formally closed off with their auditor in the SEC, but I'll say on the right-hand side are comments that their chief financial officer made in last quarter's earnings call, May 8th. They actually report second quarter on August 7th, so they'll report next Thursday. This doesn't throw me off entirely, and I'll tell you why. I was involved in my former company with the mergers and acquisitions group. I worked in a number of mergers and acquisitions, and particularly of smaller companies. As smaller companies grow quickly, they not only have to change and grow their primary processes, what makes their products, they have to grow the back office processes too. And you often find that those might not get the first priority of investment dollars or consideration. So those kind of things happen. But bottom line, what they had was a manual process to verify the reports for their revenue, their contracts going forward, and didn't have that what could be automated. So the CFO declared last quarter that it was a design deficiency. It was recommended to be automated instead of manual, and that they don't expect to do any restatements or any changes that's going on. It's a growing pain. So this might turn you off, but you know, when you have these launchpad companies and you see them growing, it's something to grow into, and that kind of gives me, I'll say I'm more comfortable with that kind of risk than some. So getting into the SSG, I did turn off 2017, 21, and 22. Again, remember the revenue line is right straight, but the earnings lines are a little bumpy, and I'm just trying to get a forecast line I can put against my projections because I don't have a lot of data. So again, I've put in, as in the forecast estimates on the data menu, I've put in the company's guidance for 2025 and 2027. And I've put in the value line guidance, so the more conservative of the two between Value Line and Morningstar for 2029. So I'm using the round number of 18, which looks pretty in line with revenue. It is still a slowdown. So in that perspective, I will view it as conservative. They have said, the company has said in particular 2025, they are running into some supply constraints. They're expanding the Missouri plant in addition to building the Indiana plant, which won't come online till late next year. And as the bird flu has ravaged the industry, they're not having trouble, but new farms aren't coming on as quickly. So they actually reduced earnings versus last year a little bit. You can see the first dot for the first quarter is down from the 2024 level, but they expect by the end of this year that it will resume its upward trend. So a little bit more optimistic than Value Line, not quite as optimistic as Manifest as we go into the back page. So next slide is section 2 and section 3. The one thing to note for section 2 in a fast-growing company, almost no debt. In fact, this $1.6 billion capitalized company has $160 million in cash sitting on its balance sheet. So they can do what they want. They're earning excellent return on equity. That's a great lineup without leveraging it to debt. As a young company looking at section 3, of course, I strike out just about all of the PEs because that's sort of an IPO PE level. You might still be uncomfortable with the 35 for your average high. Remember, this is an 18%, let's say, conservative growing company. Could be a lot higher than that. I don't think that's bad at all. And 14.5 for a low is certainly what you see or what you'd expect to see in the food industry. So let's go to section 4. Next slide. So taking the high and low, and remember these are really the last 2 years because that's really where we've had rational pricing, gets me just on the edge of a buy zone, 3-to-1. Again, that might be a point where you kind of wonder what's going on, but I will skip right ahead, having mentioned that, to section 5 and talk about the measurements altogether. So 3-to-1 upside downside, but what we'll see a compound annual return of 21.7% and par calculated at 13.5%, with manifest par right in the middle of that, about 18.1%. So it is a young company. It probably will have some volatility. They are still investing in the company, which could show up in earnings. Not debt to do it. They're just paying the cash. But it's quite an opportunity in an area, and I didn't mention it. Thinking back to that map and all the farmsmen out there, their strategy, and again, they started in 2007, but their strategy now is a natural defense against the avian flu issue that's storming the industry right now. Rather than having single factories of 50,000 to up to 6 million layers in one location and in tight quarters to be able to get the flu, no single facility of theirs, meaning those family farms, has more than 0.005% of their production. So they've had a single test case of avian flu across their whole production supply base in the last year, and 4 since they started. So naturally resilient to the industry's biggest issue right now. Have a good story to sell people, and actually distributing quite far. I look, and you can find your local distributors on their website. Within my locality, of course, they're in Whole Foods. You'd expect that, but they're also at Kroger. They're at HEB, which is our Texas native grocer. They're at Target. You might expect that too. They're at Walmart. And they also list a number of restaurants and restaurant chains that they serve as well. So quite a breadth in sales, in exposure to large retailers, and then still a long way to go in ramping up production with family farms across the Midwest and the Mid-Atlantic. That is Vital Farms.
Okay, Ken, if you're still with us, we are ready for a poll. And you may be muted on your end, Ken. I'm not hearing you.
No, it's up, Mark, but I don't know if you're seeing it yet.
Am I ahead?
I see it.
We'd like you to there. People are voting, Mark, so we're all set. Okay.
Okay.
We'd like to get around 80% voting. We're up to, we just hit 60%. So take a moment, folks. Pick which of the 4 companies you think we should add to the roundtable. If you think they're all stinkers, then vote for none of the above. Okay.
And Ken, Kevin Gologlia has checked in from the Baltimore Orioles, where he's attending the baseball game, and he'd like to vote for whatever you put out. So one extra proxy vote for Ensign Group.
Thank you, Mark.
This is quite a horse race.
We're up to 75% voting, so we'd love to get a few more of you voting. It doesn't cost anything. You can only vote once, however, so take a moment, give us a vote. And I'm going to count to 10 backwards in my mind and then close the voting down. And we're going to display the results. And Mark, you have a winner.
Brown and Brown.
Brown and Brown, yes.
How about them apples?
Well, I kind of figured that the fear and loathing that's going into healthcare at the moment would probably rub off on Ensign Group. So I still like it, but the audience doesn't. So
It's a wise audience.
Despite the globally October surprise.
There you go. All right, here's the audience's reminder. I think I'm back on displaying the screen. But this is I will be glad to be back in normal internet, normal electricity. All right, I think the audience can see it now. Just the quick reminder that we do archive all of the sessions for bull sessions. We're having a lot of good fun. Took a couple of weeks off, but in all the roundtables. So you can access roundtables going back over virtually the entire 15-year period, if you would so choose. And let's see. And just a couple of quick coming attractions. I think that's on the screen now, Ken.
yes, it is, Mark.
Do I have the date right for the July roundtable? It shouldn't say August. It should say July, right? No, I'm sorry. That should say August 30th or for the August roundtable, right?
Yes, it should.
Okay, so everybody ignore that. August 30th, and we are still going with our start time of 7. Cy and I will both be at the Georgia Investor Fair on August 23rd. Looks like a wonderful program. Look forward to seeing a lot of you down there. And that should be a great day. And the September roundtable will be, I'm pretty sure I've got that date right, September 30th. And
I'm checking the calendar right now, Mark, and it looks correct. Okay.
Yeah, I believe August would be the
Oh,
26th.
Mark, we have moved the September roundtable to the 23rd, if you remember.
well, I remember now that you told me to. Hold on.
Okay.
Let's put that back on the 23rd. I remember now that you mentioned it. And the roundtable for August is what date?
Is the 26th.
It's the 26th, right?
Yes, which would be just after rolling around Atlanta for a few days.
Correct.
Okay, we are back at it. All right, so there you have it. We will be starting that special discussion of growth over the decades, and I think we're going to have some fun with that, with the September session. So again, you can attend for that entire pre-session. Just come for the roundtable. That's up to you, whatever you would like to engage. So with that, Ken, I think we
Well, we'd
can
like
go
to
ahead
thank
and head for
everybody
the.
from coming, and we can head for the hills now. I'm going to be taking off on vacation tomorrow, and we'll see you all at Bull Session next Tuesday. 2 o'clock in the afternoon next Tuesday, we're resuming our Bull Session. So until then, thank you so much, Matt, for your presentation. I enjoyed the chicken and egg argument, and Ty, thanks
I
for
resisted
coming in.
that.
I know you did, so I used it, okay? And, thanks for coming, Cy, and Mark, thanks for all that you do for us, and go out there and beat those grandkids at tennis and pickleball again, okay?
Hey, we're gonna have some s'mores in a few minutes.
All right, that sounds real good.
But I'm gonna leave.
Good night, everybody.
I'm gonna leave the armor in
All
the
right.
closet, though.
Don't forget to credit the cheetah too.
That's right.
The
Oh,
cheetah,
that's,
well, you'll have to
yeah,
tell
the
Logie that the cheetah did it for you.
It did.
Yeah.
Golly, guys, you know what's going to happen, guys, don't you? We're going to see that darn cheetah at every single presentation now. So,
Cheetah sessions.
yeah.
yeah. Good night, everybody.
Good night.
Thanks, everybody.